Greetings, everyone. I'm Cathie Wood, CEO and CIO of ARK Invest, and it is Employment Friday when we put out in the know about all things economic and many things innovation. I mean, we're all about innovation. That's all we do all week long. This is a moment where we step back and say, okay, what is the backdrop? Today, we're going to talk about the cyclical seesaw we seem to be on. But before we do that, I would like to introduce two very special guests. We have Tasha Keeney, who is, and Sam Korus, both of whom are directors at ARK, and both of whom have spent most of their years at ARK really delving into the new world, autonomous mobility, and starting with the electric part of that, and then into the artificial intelligence. As we've mentioned many times, we don't think Tesla is a car company. It's a robot company. It's an energy storage company. Those are under Sam's purview. It is an artificial intelligence company. Tasha has done our work on autonomous mobility, working with our AI experts. And we think those technologies are converging, and that Tesla is the biggest AI project in the world. And if all of the AI stocks that are running are going to prove correct, if that run appreciation in the stock market is going to prove out, it will be because of companies like Tesla that are going to harness artificial intelligence and transform this world, and in Tesla's case, transform mobility. So with that, why don't we start with Sam? Because there is a controversy today around electric vehicles, that part of the story. And then we'll transition to Tasha. I don't think the market's incorporating any of her work in the Tesla valuation, especially if Sam's work on EVs is correct. So, Sam, you want to start?
Sure. And I think what I say is that there's this secular shift happening in a cyclical industry. And I think that's the cause of a lot of confusion. And so what I mean by that is the secular shift is going from gas-powered to electric, but all of that is happening in the auto industry, which is still cyclical. And so we're seeing that interest rates and what consumers can pay still impacts all vehicles, whether those are gas or electric. And we saw that, right, US SAAR for March was 15.5 million, which was lower than the 15.9 million consensus. But there's definitely been a particular pushback on electric vehicles. And so often we'll hear people saying that they're too expensive, the range is too short, there's not enough charging infrastructure. And all of this is changing as battery costs come down, as infrastructure continues to be built out quite rapidly. And so what's giving us so much confidence that, these quarterly numbers are just short-term noise? Well, that's the fact that the Model Y was the best-selling vehicle in the world. And we're putting up a chart now, which I'll walk through if you're just listening. But this essentially shows the price elasticity of demand for electric vehicles. So on the x-axis, you have the inflation-adjusted.
This is on the right-hand chart,
yes, on the right-hand chart. And on the x-axis, you have inflation-adjusted US dollars representing the MSRP of a vehicle. And then on the y-axis, you have the addressable revenue share. And the Model Y is roughly, $50,000. And if you see that on the chart, that's, roughly 5 to 10% of the addressable market is available at those price points. So the fact that this was the best-selling vehicle in the world and it's operating in such a small part of the overall market shows that consumers want affordable electric vehicles. And so when we see battery costs coming down over the next 2 to 3 years, when we hear that Tesla's on the way to coming out with a low-cost electric vehicle, where then the addressable market jumps up to the 50% plus addressable revenue, that's opening up the market, almost tenfold from where it was. So we think that these short-term delivery numbers, it's almost a throwback to when the Model 3 was ramping. It's missing the forest for the trees in the whole transition to electric. And of course, yeah, go ahead, Cathie.
I was just gonna say you hit a spot there, which this does remind me of 2019 when Tesla was it was struggling. The stock was struggling because of all of this controversy. It feels like that moment again. And you have pointed out something here, Sam, that I think is really important. The Model Y being the best-selling car in the world, even though its price point is so much higher than, I think it's the Toyota Camry. Is that the what used to be the highest
Yeah.
selling car in the world? Yeah. That tells you that there are people reaching because they love these cars. And the other thing to note about the chart that you are presenting here, Sam, is this chart is not making a forecast. This chart is based on past experience with price points. At what price points do certain car sales take off, right?
Exactly. And I think the other thing, just quickly to touch on, there's the news Ford pushing back its EV plans, focusing more on hybrid as well. And I think the easy way to look at this is that hybrid relative to battery electric, the economics made most sense in 2012 when battery prices were still extremely high. If you go forward, 3 years to 2027, when battery costs are going to drop even further, the economics just keep on deteriorating for hybrids. So we think this is another short-term oriented mistake from traditional automakers.
Yeah, I just want to add to that. Because we have centered our research around Wright's law, and because Ford and GM, because GM's doing the same thing. They're both pulling back on pure electric cars because they're not profitable. Well, they're not going to be profitable unless they scale them. It's almost not possible. It's certainly ceding more of the electric vehicle market to Tesla longer term, right? If they're not putting in those investment dollars and scaling now.
Definitely. I think it makes it for anyone who's pushing through for pure electric, they're going to have more battery capacity at lower prices. And so it kind of falls into their hands. It somewhat reminds me of COVID when they canceled chip orders, very short-term oriented again, and then spent the next 2 years saying, we're supply constrained because the chip manufacturers shut down those plants and they can't get it back. So I feel like this is going to be another moment of regret.
And yeah, even though Tesla did face some chip shortages, I think it got it was moved up in the line because it never stopped production in China, especially, and so it became a larger share for chip manufacturers than some of the other auto companies who pulled back. They shut down production.
Absolutely. And of course, this is just one side of this big shift going from gas to electric. The even more impactful is going from human-driven to autonomous, and there's been exciting news there. So Tasha, do you want to take us through that?
Thanks, Sam. Yeah, I think, while all the focus right now is really over this concern over demand, looking at, quarterly delivery numbers, I feel like what many people are missing and what we believe is not baked into the stock price is autonomous driving for Tesla. And recently, Tesla has been releasing their full self-driving FSD version 12 via over-the-air software updates to Tesla owners. It's gone into wide release now. Tesla has also started to give any Tesla owner that has a capable vehicle access to 1 month free of FSD. And importantly, and so one, why is this update important? Why is FSD 12 important? Well, it's moving towards, a single stack approach. We've heard Tesla say that it's eliminating over 300,000 lines of manually written C++ code. So you can think of this as a less manually written, AI architecture moving towards, nothing but nets. Is the approach that Elon that's what Elon calls the approach. It's a totally AI driven approach. You're not training the vehicle on what a stop sign is. It's actually learning that from just looking at many images and videos coming from customer cars. And so we've seen a lot of reports, and Tesla has been augmenting these reports on Twitter. I highly suggest everyone go take a look at these videos. The most dramatic improvement that we're seeing in this latest version of FSD is really on city streets. I know personally from my Tesla, I use it here in New York City and in Connecticut, and I've noticed a really dramatic improvement again on those city streets that, previously the car was a lot more cautious. It's just becoming more human-like. And ultimately, we think that autonomous driving could be 2/3 of the future enterprise value of Tesla. So last year, we published our price target for 2027. We estimated that Tesla could reach $2,000 per share in our base case. We're working on updating that work right now, so please look out for that update. But I think that is, again, something that the street is really not baking in here, the importance of autonomous driving.
But just to Tasha's point, right, the Reuters article came out today saying that they'd canceled the low-cost vehicle, and the stock price dropped roughly 5%, just going to show that people really are not, taking into account the robotaxi element for Tesla.
Yeah, because that low-cost car, that 25,000? It's somewhere in the 20 to 25,000 range that we think they'll have in 2 years, right? 2025 sometime.
Yeah.
2025, 2026. Yeah, think about that. We just said the Y is 50. They're going to 20 to 25,000, and we think all electric vehicles are going to be dropping in price, according to Wright's law. So that's a big part of the story, and Elon came right out and denied that rumor. But I don't think even though the stock went down, I don't think people appreciate, how important that car is going to be to making the autonomous taxi network viable and real.
Yeah, exactly, Cathie. And I think that, the reaction really shows that people are thinking of the $25,000 car in the context of consumers buying vehicles. When in reality, once autonomous driving happens, what's actually important is, the underlying cost structure of the car. So we already know that from Sam's work on a like-for-like basis, an EV is cheaper, both from a total cost of ownership perspective, but also just from a sticker price perspective compared to a gas-powered car. And of course, when you're operating an autonomous driving robotaxi network, you want these highly utilized vehicles to have low operating costs. So I feel like everyone's concerned, well, they need the $25,000 car for consumers. When really, I think what, initially the article said, which is, Tesla might focus more on robotaxis for the time being. Of course, again, Elon said that Reuters didn't get it right. But, that is where the cheaper vehicle actually, becomes very important for autonomous driving.
Yeah, so I think what we're saying is, the traditional auto manufacturers, they're pulling back, going more hybrid. Tesla is not. It's going full throttle ahead as quickly as it can and as quickly as the economy allows. That certainly interest rate increases have lowered the affordability of all cars, not just Tesla's cars. When people debate us on what's really going on in the economy, we can point to these to this kind of evidence that the consumer cannot afford at these interest rates some of these vehicles or lots of vehicles. That is a real economic impact. So when we get into the tailwind, when interest rates come down, the pent-up demand is going to be there. One other thing I just wanted to focus on before we leave is I think we're all noticing from our own experience with FSD 12 that, as you said, Tasha, the drive is more human-like when it's in FSD, and in fact it's maybe a little more, because I've noticed in terms of lane changing on surface streets that my Y is perhaps a little more aggressive than I might have been, and it's safe, and it's the correct thing to do. It's getting me where I want faster than otherwise would be the case. I don't know if you all are having the same experience.
Yeah, I totally agree, and I think again that's really where we're seeing the major improvement is on the off-highway portion, which is really difficult to drive, arguably more difficult to drive. On speed, we also just heard that Elon said that Tesla is no longer AI training compute constrained, which is huge. So, I mean, that could mean a variety of factors. We've written about this. It could mean maybe they got more NVIDIA chips. Maybe he sees line of sight to, getting those orders in. But either way, what it means for FSD and autonomous driving is that the updates that you'll get on the over-the-air updates should be able to come more frequently, because we knew before that really was the gating factor, was training compute. So you can think of this as now Tesla takes in all the videos, the clips from customers, they're able to act and make actionable insights on that information and update the software more frequently. They've said that this will happen roughly every 2 weeks. That seems faster than before because people had previously been reporting, a major update comes about once a month. So it's really just getting them closer to that milestone of, eventually us being able to take our hands off the wheel and enabling a robotaxi service.
And just two more points. I know we could go on and on about this, and when I say something, you'll probably have a few more points. But no more constrained, no more by compute, which means chip supplies are loosening up, and I do think that NVIDIA, the shortages of supply that caused backlogs, those are diminishing, and so we'll see how that plays out in NVIDIA's revenue and earnings going forward. The other point that I don't think we are even making enough is the safety that we're going to see thanks to FSD, and in fact, it's not even a futures-oriented comment. We're already seeing Tesla as the safest car in the world. Remember, Volvo built its brand on this. Tesla, we believe, has surpassed Volvo, and maybe, Tasha, you can give some of the safety stats based on your research.
Yeah, so if you look at the figures that Tesla reports, which are the number of accidents in both drivers that use autopilot and do not use autopilot. And actually, they've also reported FSD specifically in one of their presentations, and this is in our Big Ideas report. If you adjust for pre the single stack update. So before city streets and highway driving was in a more integrated architecture, actually driving on a city street or a surface street I said it was more complicated because although it's fewer miles driven on these streets, it's actually more accidents on these streets. So if you adjust again for that update, it looks as if a car that is using FSD is roughly 5 times safer than a car that's not using autopilot. So you can think of that as a human-driven Tesla. And then, a human-driven Tesla has all these already baked in assisted driving features. So when you look at the national statistics for driving compared to the national average, it's even safer than that. So, 5 times safer FSD. If you look at, Tesla's most recent safety reports, even if you don't make that surface street adjustment, it's still, 3 to 5 times faster. If you look at sort of the past 2 years, sorry, 3 to 5 times safer if you look at the past 2 years. So, cut a number of different ways. We already have early evidence that these features are, saving us in our everyday driving, and we have a lot of anecdotal evidence about that as well.
Right. And it's not just anecdotal. I mean, the numbers that stick in my head are, and this is just surface street. So the national average for the number of miles between accidents for the average car on the road is roughly 200,000. For a Tesla without FSD, it's roughly 600,000. So that car, human-driven Tesla, is 3 times safer. And then the number with FSD is 3.2 million miles. I mean, these are astonishing numbers, and I don't think anyone's going to be able to catch Tesla on this, not anytime soon. And then just to wrap this up, maybe Sam, back to you on, I don't think anyone's really thinking about the impact on Tesla of robotics generally and humanoid robots longer term. So maybe we can you can give everyone a glimpse into the future, and this is purely a call option, right?
Yeah, and they're actively working on this, but we've sized the market as a potential $24+ trillion global revenue opportunity, roughly half of which in manufacturing and roughly half of which could be in household robotics. And I think there probably will be a lot of learning taken from autonomous driving to the robotics side. So we're excited to see what they do there.
Yeah.
And
Okay, well, thank you so much, Tasha, Sam. And now we'll get on. This was the much more exciting part of the show, maybe why some people tuned in. But now we will switch to the economic side, which includes fiscal policy, monetary policy, economic indicators, and market indicators. What the heck is going on out there? Trying to make sense of all the numbers that have come through in the last month. So starting with fiscal policy. Here you can see the budget deficit. This is the federal budget deficit in the United States. I say deficit because it mostly has been in deficit over all of these years, and this goes back to the late 60s. So you can see where we are in terms of the deficit, how record-breaking the deficit was, understandably, during COVID. We got down to more than 17% of GDP was the deficit. Now we're up to, or we've improved to 7%, but in the context of history, this is still a terrible number, given that we're in an expansion, in the expansion phase of the economy. You can see even in the profligate 70s, we didn't get any worse than, we didn't even reach 5% of GDP. Now, there is something really important from this chart. If you look at the period from 1990 to 2000, you'll see a big improvement in the deficit. What was that all about? Well, we do know that the Clinton administration showed a lot of discipline, but there was something bigger going on, and we think it could happen again and take away all of the worry out there, maybe not all of it, but a lot of the worry about what this deficit is going to do in terms of crowding out the private market, government taking more share of the GDP pie. If you look at the 90s and recall what was happening back then, that was the internet age. We were just beginning the internet age as it relates to the consumer, importantly. So the early 90s, I remember well in, I think it was 1993, was the first time email was connected to the internet. And that was the Chat GPT moment back then. It was like, wow. And I was there, and I can vouch for that. And that is when Cisco and others started building out aggressively the backbone for the internet around the world. To enable all of the applications that began to evolve in the 90s and which then turned into an explosion by the end of the 90s in terms of laying down fiber and introducing consumer applications, Amazon, Yahoo, AOL. It was a wonderful time in the market. It went too far because the technologies that were going to take the internet to the next level, the cloud, artificial intelligence, and so forth, it was going to be years before they were developed. So the technologies weren't ready for the dream that took place during the tech and telecom bubble. The technologies were not ready. And the costs were way too high, the costs of all kinds of innovation. And of course, that ended in the tech and telecom bust. Well, the seeds for all of the innovation that around which ARK has centered its research and investing, the seeds were planted in the 20 years that ended in the tech and telecom bubble and then the bust. The seeds were planted. They've been germinating, and we've seen breakthroughs like deep learning in 2012 with ImageNet, transformer architecture in 2017, and of course GPT-4 now. So the seeds, though, were planted back then, and they're basically coming into full bloom now. We're entering prime time for the innovation that was a dream in the late 80s. So if it was a dream in the late 90s, if it was a dream back then, you can imagine how explosive the growth opportunities are now. And that is what will get this deficit, will move this number from deficit into surplus. And no one is really expecting that right now, but we would not be surprised to see within the next 5 to 10 years a surplus, which will take away a lot of the fears about in the fixed income markets and in the equity markets about how the government is crowding out the private sector and putting upward pressure on interest rates. I do want to show the next chart, which is interest rates. So this is the spending on interest as a percent of GDP. And you can see during the 70s, it started to build and it peaked out in the 90s. You can see it 2%, roughly 2% of GDP. Well, we're back at, 3% of GDP. We're back at 2.5% now, having gone nearly to 1%. We're at 2.5% now. And according to the Congressional Budget Office, and that's a nonpartisan government agency, at 4% interest rates on average, and they just carry 4% through to 2055. Interest alone will mount to 6% plus of GDP. That's government spending just going to interest rates, interest costs. Now, it is true there's another side to those interest costs. It is the people who are invested in Treasury bonds are getting coupon payments. So they can turn around and spend them. But nonetheless, this does give you a sense of what the spending, especially during COVID and COVID times, has done to elevate interest costs as a percent of GDP for the next 10, 20, 30 years. So we'll see if we get to such a surplus that we will be paying down debt to help this number out. On to monetary policy. So as we've been presenting, this chart, M2 and versus CPI inflation. So the green line is CPI inflation. The purple line is money growth. And we, as you can see, we've pushed it forward because money leads inflation. Milton Friedman told us that from the University of Chicago. Money is always behind the inflation rates. And how quickly it works is variable. And so you can see on this chart, the left-hand side, that scale is the CPI, and you can see we're around 3%, and we've been stuck there for a little while now. Now, this is much better than what people feared in 2021 when they thought, okay, this kind of money growth means we are going to see inflation like we saw in the 70s, in the high single digits for years. So it's not high single digits, it's low single digits. But look at what money growth is suggesting will happen during the next few years. It could go, and we think it will go, negative. And one of the reasons it will is rent. The stickiness of the CPI has to do more with rent than anything else. And it's a huge lagging indicator in the CPI, the way it's calculated. If you use some of the real-time indicators of rents around the nation, some of those are already flashing red. They're going down. And we think that's going to get, it depends on your point of view, whether you're a landlord or a renter. From the renter's point of view, it's going to get even better because there's so much supply coming into the system. Private equity and private credit was reaching for yield during the many years of near zero interest rates we had, and they really started in 08, 09. So near zero interest rates for 13, 14 years. And so they wanted to juice up their yields. They invested in multifamily dwellings, apartment houses, and leveraged those up. And they earned a pretty nice yield. Rents have been much better than Treasury yields, especially when they're leveraged up. And because that worked for so long, there is now a lot of supply hitting the system. You have to go back to the days in the 70s when real estate was much more of a tax shelter than it is today. It was a pure play tax shelter in the 70s. You have to go back to then to see as many multifamily units coming on the market in the next 2 years, about 1 million. And so that's going to drive rents down. And we think that will drive the CPI inflation rate down. You can see in 2014 to 20, money supply, the inflation rate was below the money supply for the most part. And we think that will, well, it'll have to go negative to prove the same this time around, but we think that will happen. The one other thing I will say about this chart and about money supply generally is many people say, well, we've never seen the money supply go to 27%. So, inflation is probably much more baked in the cake. Well, if you go back to, and maybe in the next month, we'll show you that chart. If you do go back to World War II and the Great Depression, money growth rates did get up into the 20s. In the Depression, we were in a liquidity trap. So people were so scared they weren't spending, and it was ineffective. And in World War II, the money printing was to finance the war. And that war lasted a long time, much longer than COVID did. And so the rapid money growth rates were much more sustained. And yet when money growth came down, inflation came down very dramatically after World War II as well. And we ended in the low single digits. So, okay, the next chart takes us to what consumers are thinking about inflation now. So the University of Michigan does a consumer sentiment survey and one of the measures is 1 year inflation expectations. And you can see that the purple line here is the University of Michigan. The green line is the Fed's survey of consumer expectations. So both of them now have dropped from the 5.5% to 6.5% range to a little below 3%. Now, what's important about that? The Fed is looking for 2% inflation. You can see here, going back to 2013, that this metric, even though inflation dropped below 2%, this measure rarely gets below 2%, and it's already got a 2 handle. And if we're right with rents and so forth, this measure will continue to come down. Now, there is something that's a bit of a wrench in the works right now, and that's gasoline prices. The oil price has bumped back up. It will probably hit this metric. It did not hit it in the last measure, which was interesting. The last measure ticked down, as you can see in the purple line there, and that was, I believe, that was a late March number. So gasoline prices have been going up, but for some reason, maybe it's egg prices, some food prices are coming down. The consumer is expecting less inflation during the next year. It'll probably move up a bit because of gasoline prices, and I know that's going to be a worry that the equity markets will focus on. But we think, as we showed you in the previous chart, that the trend is down. And if we're right, it'll go negative. This yield curve chart is one reason we believe, or another reason we believe that will be the case. So money supply growth is one reason. The yield curve is the 10-year Treasury yield minus the 2-year Treasury yield. And usually the longer-term Treasury yields are higher than the shorter-term ones. Longer time frame, more risk, and so forth. More risk that inflation will be a worry. As you can see, however, the 10-year is still below the 2-year yield. And what that usually means is the bond market is seeing something to suggest that nominal GDP will be lower than expected. Nominal GDP includes both unit growth and inflation. So it sees one or both of those being lower than expected and lower than we're seeing now. And what that means is, either a harder landing in the economy. Let's just say as companies lose pricing power, they start, and their unit growth is weak. They probably will be laying people off. They have refrained from doing so, even though the economy has been slowing. because it was so hard to get labor, especially during COVID. We think that's changing. The unemployment rate has hooked up. The unemployment rate did come out today. We'll talk about that a little bit more in the economic section. But it's still below 4%. We think the trigger above 4% will be because companies are losing pricing power and they are willing to lay more people off now. The other reason for an inverted yield curve is much lower than expected inflation. So either recession, lower than expected inflation. And I think the big surprise for the Fed has been inflation has come down in a way it did not expect. And unit growth has remained stronger for longer, although there are conflicting metrics on that score. I've mentioned in the nose the difference between GDP and GDI. And so they are not really in agreement, although GDI was revised up recently, a little bit closer to GDP. So if we're right, inflation will continue to surprise on the low side of expectations. And what's nice about what has happened with Fed policy is whereas they used to think employment increases were negative in terms of their mandate to get inflation under control. Now they are not thinking that as much. And that's a good sign because guess what? Over the last 40 years, real growth and employment has been associated with falling inflation. Real growth is associated with productivity gains, which are a significant antidote to inflation. And we think that's one of the things that's been going on. Nonetheless, that disconnect, the Fed disconnecting real from inflation is very important and bullish, I think. Here's the real Fed funds rate. What is this? This is Fed funds, the Fed funds rate minus the CPI. So it's at about 5.5%. The CPI is at roughly 3%. So you see here 2.5%. If we are right and inflation goes negative and the Fed funds rate were not to change, it would head up to that 7.5%, 8% that we saw last in the early 80s. Now, again, nothing happens in a straight line. We think some of the prices, like gasoline prices, are going to throw us off a bit on inflation. It may be that we hang around this 3%, 3 to 3.5% for longer because of that. But if growth is correct, and if our outlook about pricing power, corporate pricing power is correct, then we think it will resolve to the downside and will not continue up. What's interesting in the rest of the world led us into higher interest rates. This is typically true because emerging markets are at greater risk of inflation, and so they acted sooner than we did. Many of them in 2021. You can see Colombia was one of the first to lift interest rates. Others here, Brazil, Mexico, Hungary, Czech Republic. The reason we put in Switzerland, it was not early to raise interest rates. It was more like the Fed. But you can see it is the first developed market to cut interest rates here. And one of the reasons that it's cutting rates is its currency was appreciating, threatening deflation in that country. The reason the emerging markets are cutting rates now is because they are experiencing some pain. The dollar has been going up, and many of them have dollar-denominated debt, and so it's very difficult to service that debt as their currencies have been depreciating. I think what they're doing here is trying to stimulate their economies back into a unit growth dynamic. Because again, maybe they understand better than a lot of policymakers that if you get unit growth up, you'll get productivity growth up and inflation down. They're in a bit of a difficult situation, I must say, because, and we'll go through this in a minute, there are now devaluations in currencies. They're being forced. They're being forced because of the strong dollar is forcing them into devaluations that they don't want. Devaluations are inflationary, so it's a vicious cycle. And they're now cutting interest rates. So it's an interesting dynamic. There's a lot of, not enough people in the United States pay attention to what's going on in the rest of the world, especially the emerging markets. And I'll tell you another thing that I think is going on. There is a new money, a new currency out there that people in emerging markets, if they have a digital wallet and an internet connection, they can buy Bitcoin, so they can protect themselves against currency devaluations. And I think more of this is going on than a lot of these countries are willing to admit or even recognize. So now we'll go on to economic indicators and get into more of that. Here I mentioned it actually wasn't an upward revision to GDI. GDI comes out with a lag, and it was flatlining, as you can see, relative to real GDP. They should be equal over time, and you can see this is a record-breaking gap that's opened up. GDI is saying the economy is much weaker than GDP is saying, and from company reports that we are getting, I would agree more with GDI than GDP. I mean, the latest example, Ulta, which is a company in the makeup space, sells through Sephora. It announced surprisingly weak results. Now, that's discretionary spending, and it's probably the last part of discretionary spending that a lot of young women will refuse to give up on, but some of them are, because times are getting tough for some of them out of there, whether it's unemployment or having to take pay cuts or inflation eating into their budgets. Something's going on out there. Here's another set of metrics that are now continuing to conflict. Manufacturing had been very weak, as you can see in the green line here. And you can see the shaded gray areas are where you see recessions. The Manufacturers Purchasing Managers Index was effectively in recession territory and is just back to flat. While the services sector had been holding up, and now it is ticking down. So we're watching this very carefully because services are a much bigger part of the economy. And they do seem to be struggling more now. And you can see, even compared to other times in this chart, services today are closer to where they are when we're entering a recession than they are during expansion phases. Another very interesting dichotomy is on this chart. And this is, non-farm payroll. We got that number today, Employment Friday. It was much stronger than expected. That's in the blue line. And this is depicting that on a year-over-year percent change basis. So you can see it peaked. Employment, well, at first it crashed. We were down 15% year over year during COVID, and then it soared and got to a little over 10% there. And you can see now it is down closer to 2%, maybe a little over 2%. But look at the green line. This is household employment growth. Now, in today's report, it was strong. In the last 3 months, it had lost 1 million jobs, but today it made up more than 400,000 of those losses. But on a year-over-year basis, household employment, this is the metric measured by a survey of households, actually calling people up and saying, "Are you employed?" And here you see you see a drop off to nearly zero. It's barely growing at all, even with the strong report this time around. That said, most of the report was strong. Hours were strong. They were up 1/10, having fallen the previous month. Average hourly earnings were as expected, 0.3 versus 0.2 last month, so a little stronger on that score. And so it was a strong report suggesting income growth is fine. But on a year-over-year basis, you can see this slowdown, and household includes more small businesses than non-farm payroll. And in a moment, I'll show you how much small businesses are struggling. But before we get there, temporary help also continues to fall. It wasn't down that much in the last month, but it was down. And so you can see we don't have the inflation shaded here, but typically by the time it's down this far, we are in a recession. So that's interesting. Here you can see a dichotomy in the consumer sentiment index by household income cohorts. So you see the top 33% and the bottom 33% of income earners in the country. And you can take a look at those gray shaded areas again. Those are the recessions. And you can see the bottom third, their sentiment is in recession territory. The top third is not in recession territory, but it's not in exuberant. It's in okay territory. It tends to be a little higher than this during most expansions. So not great, but much better than the lower income cohort. We're seeing a lot of these dichotomies. And here's small business. I mentioned they're the ones who are struggling and probably laying off people. Again, you can see the Small Business Optimism Index as measured by the National Federation of Independent Business. It's right there down in recession territory. No doubt about that. Worse than COVID. Not as bad as 0809, but getting there. But much worse than the tech and telecom bust recession, much worse than the S&L crisis recession in the 90s. So small businesses are hurting. And again, so when the headline numbers come out and say everyone says, "Oh, everything's fine," they're not looking deeply at what's going on out there. There are a lot of people and businesses who are feeling some pain. Now on to existing home sales. We've been saying for some time that the economy is in a rolling recession. One of the first places we saw it, or have seen it, not in response to COVID. In fact, quite the opposite. Home sales boomed as people bought a second home to get out of the city. And so you saw a nice increase there, but up to more than 6.5 million units at an annual rate. And then when interest rates started going up, you can see almost immediately existing home sales, the unit sales started going down. So they dropped at their low late last year, early this year, below 4 million units at an annual rate. So from more than 6 million to below 4 million. That's a recession. That's a recession, actually, that rivals 0809 when it comes to housing alone. So this sector certainly has been in a recession. You see a little bit of a lift recently, and that is because interest rates, mortgage rates at least, have come down from 8-ish% to closer to 7%. So giving, some homeowners reason to move. There are many homeowners who will not move because they locked in mortgages sometime in the last decade in the, say, 2 to 3% range. There's no way they're going to move now if they're going to have to pay, a 6 to 7% mortgage, and that still is the case. But some at the margin will move. On the next chart, you can see new home sales. Now, the demand for housing is there. There is a shortage of housing. And what surprised me about this metric is it too acts like housing's in a recession, because I guess first-time home buyers can't afford houses. The interest rates took them out of the market. They were starting to move in, and you can see it started up slowly but surely. But higher interest rates just killed it. We've gone from more than 1 million sales in this category to we've got to roughly half of that very recently. So still housing is grappling with these interest rates. One of the reasons new homes might start selling is the builders are starting to cut prices, which is very interesting. Here you can see new home, this is total, this is US median sales price. So half of the prices of homes sold, new homes sold, are higher than this, and half of the prices are lower than this. So that median price has dropped from 500,000 to 400,000 and is down 7% plus on a year-over-year basis. So builders don't want to be stuck with the inventory either, and have started to cut prices to move houses or to build lower-priced homes in the first place. So that is one adjustment that we're seeing here. And here is a year-over-year change in existing home prices. Those did go negative with those interest rates, hitting 8%, mortgage rates, that is. And with mortgage rates coming down, those are up to 5%. Unless mortgage rates come down more, and I think that will depend on what Fed policy does, I'd be surprised to see these prices move much more on this basis, but we shall see. Again, in this rolling recession narrative, auto sales, especially after interest rates started rising, didn't get near that 17.5, 18 million units that we usually see in steady state during expansions. We're kind of stuck in the 15 to 16 million unit range, and the last month was a tick down. It went from, I think it was 15.9 to 15.4 or something. So at the margin, auto sales are not strong. And again, there could be some reasons associated with more people deciding not to buy a car and just use Uber, although I've taken a few or lots of Uber cars recently, and I just cannot believe the prices out there. So I think that when Tesla launches its autonomous service, it will undercut Uber, and then we'll see what happens. One of the strongest parts of the economy it has to do with technology and the build out of data centers in this new AI world. So you can see the last chart there. Look at what has happened after years of computer and electronic manufacturing plants going nowhere. No one was building effectively data centers and other manufacturing plants. You can see that they have skyrocketed since 21. Most of this is data centers. That's computer and electronics, they call it. But look at that. It's up tenfold. And that's what's driving GPU sales, NVIDIA sales. I think there's going to be a lot more competition and commoditization in artificial intelligence than anyone now anticipates. We're doing a lot of work on that, so stay tuned for that. And already we're beginning to see consolidation. Inflection was a company that had been VC funded. Reid Hoffman, declared victory when basically they sold the bulk of it to Microsoft and kept a part of it. But that's consolidation. They couldn't make money. And we're going to see a lot of VC-funded AI startups in the foundation model space are probably not going to make it. So I think we will see a bit of a shakeout there, and that at some point, I don't know when, NVIDIA will end up with an inventory problem. Already, Tesla, as Sam mentioned or Tasha mentioned, is saying we don't have any problem getting chips anymore. That's a big change from a year ago. And I do remember in the early days of the internet, those early 90s, as I showed you before, I remember that Cisco went crazy after that ChatGPT moment when email was hooked up to the internet. And then 1 year later, and that would be exactly 30 years ago, just like ChatGPT was 30 years from the time the email was hooked up to the internet. 1 year ago, Cisco actually went through a very serious correction because, for two reasons. Strategic decision makers inside corporations were saying, wait a minute, we have to figure out how we're going to invest in this. Let's get our strategy in place. Today, I think a lot of C-suite are saying, wait a minute, all of our divisions are doing something with all these AI tools. Let's get strategic about this. Let's aggregate our data, clean it up. Let's map out our workflows in extreme detail so we can harness these tools and become more productive. So we wouldn't be surprised to see an inventory buildup. NVIDIA historically has been a very cyclical company, very cyclical. Probably the reason we pulled away from it faster than we otherwise would have, because we've seen these cycles before. That said, we think NVIDIA is the superstar of this AI chip age, and while we'll see competition from AMD and from the hyperscalers, all of whom are building their chips, that won't be in earnest for a number of years. Here's another thing we're watching. You can see whenever the S&P trailing earnings per share starts to flatten out, it's usually getting ready to fall. And that brings us back to my comments about pricing power. We do think pricing power, that companies are going to lose a lot of pricing power, and that they're probably going to accelerate their movement towards AI to increase productivity, but they will also, in doing so, be laying some people off. And then finally, onto market indicators. I realize this is a long one, so thank you for all of you who are still with us here. The dollar is strong. This chart shows the supercycle in the 80s. And that was a highly deflationary period for the world. Now, I mentioned some of the devaluations before, but take a look at this. So the Nigerian Naira, which, sure, it's had a history of a depreciating currency, but look, it went into overdrive over the last 9 months. A new administration, they've lost 2/3 of their purchasing power, perhaps 2/3 of their wealth if they had all their eggs in the Naira basket. You can also see Egypt devalued 40% in March. This is usually, I look at the emerging markets for trouble emerging. Many people are just looking at the US. That's a mistake when this sort of thing is going on. And I think it's telling us something about either capital flight or flight to safety. It doesn't even have to be flight from the country. It could be, as I mentioned earlier, just taking some of these currencies and, and putting and converting them into Bitcoin, into a digital wallet. Commodities and currencies are priced at the margin. And I do believe we're at the early stages of individuals in these countries saying, wait a minute, I need to get an insurance policy because this is crazy. And it's very interesting to me also that the UAE, I think it was Abu Dhabi directly, I think it was 1/3 of its own reserves it invested in Egypt. And in Egypt was a hotspot in the Middle East and set off a lot of, shall I say, it was disarray, but there was unhappiness with the economic policies in the Middle East, and it destabilized the Middle East. And of course, the Middle East has been further destabilized by the war in Israel. So I do think we're going to see more of that. Here is the Chinese RMB, the yuan, and here, with this line going up from 1980 to the mid-90s, China devalued its currency. So what this is saying, this line going up means $1 buys more and more RMB or yuan. Just like on this previous page, I should have explained that. These charts going up means the dollar is buying more of the Nigerian Naira and the Egyptian pound. You can see China was getting ready to move into really the global community. It became, I guess we signed, it entered the WTO, the World Trade Organization, in 2000, right around here. And yeah, 2000. And you can see that it had been devaluing so it could become more competitive. Its goods were cheaper, and some emerging market countries are doing that now. They're cheapening their goods so that they can enjoy more unit growth by selling to other countries. And it kept a stable exchange. Then it appreciated in its heyday. And now you'll see that it is giving some of that back. We are getting more yuan per dollar. And because China took on too much debt and there was too much speculation on real estate for years throughout this 20-year period, I think they're going to be dealing with the fallout from that for years as well. So I think we're watching carefully to see what happens to the yuan here. And here are two countries that are more regular in terms of their depreciation. So those populations probably already are taking out insurance policies. But you can see the dollar is appreciating against both the Indian rupee and the Indonesian rupiah as well. And here, I always like to focus back on this. When people start talking about an inflationary world, I look at this chart and I say, that was a problem in the 2000s to 2010s after the Fed stimulated during the Russian default, the long-term capital implosion, long-term capital management implosion. These are in the late 90s, and Y2K, and then the recession. The inflation occurred, you can see there, as this Bloomberg Commodity Price Index, which is, gold, as oil, food, everything. We saw real inflation then. We are not seeing that inflation now. And in fact, when we have the benefit of hindsight, I think we'll be looking at this as a continuation of the deflationary world that started back then. There's a deflationary trend in place. And then here's a confirmation of that. The green line is the long-term Treasury yield, and it's been moving up since 2020, sometime in 2021. The lavender line is the ratio of the metals price to the gold price. And you can see very interestingly there that gold's purchasing power is going up as this blue line or lavender line goes down. And what that's saying is the recent increase in the gold price, and it has broken out, is more a flight to safety signal than it is an inflation signal. And as you can see, the interest rate usually, certainly since 08-09, has fallen into line with the metals to gold ratio. It has not done so yet. If it did, we'd be closer to 1% on the long-term Treasury yield. How would we get there? It would be these deflationary undercurrents. And, I'll put into that category the devaluations in the rest of the world, especially the emerging markets, that are those devaluations suggest to us, as do the falling interest rates in those countries, that there is a recessionary undercurrent in the global economy. And maybe these two lines will meet in the middle. But so far, even with the gold price breaking out, this metric looks like it might want to break down. We're watching that very carefully. And so the final chart here is the one that's most confusing to me, and that is credit default swaps. So these are insurance policies against bankruptcies. And you can see when the line goes up, as it shot up during 2020, that was fear of bankruptcies. And so investors were taking out protection in the form of credit default swaps, CDSs. And you saw that was happening when the Fed started to raise interest rates. They started going up again. They went straight up. And then they topped out, and they've been coming down ever since. Now, what's so interesting about this is there was a report this last week in Bloomberg that in the last week, we have seen more large company bankruptcies in the United States than at any other week since 08-09. So what I think the history of this series shows is there's some indicator that gets the market all worked up. That indicator, was a Bloomberg article. Not many people took much note of it. But if bankruptcies are proliferating, and I see them all the time, these are companies with $500 million, $1 billion in sales. They aren't pre-revenue companies. They're going bankrupt. But they're not getting a lot of attention. One of them will one of these days. And that's when this kind of metric really shoots up. Right now, it seems to be feasting on what it believes are good economic indicators. But as I've tried to show, there's a big bifurcation between large companies and small companies. And the bankruptcy metric I just told you about was for large companies, and they're doing pretty well. Can you imagine how many small businesses are going under? And at some point, the market will take note. So I'm not going to end on bad news. I'll revert back to innovation and two things. One, we started with Tesla. I do feel like Tesla today is very much where it was in 2019, where there were a lot of doubters. Back then, it was production hell. No one thought that the Model 3 could scale. They didn't think that Elon was going to be able to pull it off with that kind of battery technology on a large scale. And he did. And of course, the stock went crazy to the upside when analysts and investors could no longer deny that. So what will cause the turnaround this time? I think the ingredients are all there. To see GM and Ford pull away from electric and cede more of the market already to Tesla, that's very interesting. Many people ask about Chinese competition. If you look at the last quarter, fourth quarter, BYD surpassed Tesla for the first time in pure battery electric vehicles. In the first quarter, Tesla retook the lead. China's having a lot of problems, as I mentioned before, and BYD is now beginning to suffer to the point where it will probably try and export more. And we know that policymakers both here and in Europe are beginning to get somewhat concerned about that. I believe in free trade, and I think that BYD coming into this market will accelerate the trend toward electric, which will, according to Wright's Law, lower the cost of electric even faster for Tesla as well, in terms of costs. So where we stand on that score. And if anything, FSD version 12.3 has increased our confidence that we are so much closer now to autonomous mobility. It is already safer than human drivers. We know that. We gave you the statistics up front. Volvo made a brand on that. And I think Tesla will turn around. And if it doesn't pound the table or pound the drum on that particular source of branding, we certainly will. So with that, I wish you, first of all, thank you. If you're with me still, you've lasted a longer time than we have for some time, but really wanted to get the Tesla story out there a little bit more, the Tesla opportunity, and talk about all of the disconnects, not just in the United States, but around the world. The rest of the world's in recession. We really do believe that. U.S. is not. I think immigration's a big part of that. And some of these statistics are suggesting that that is right. Probably should have focused on that a little bit more. So I buried the lead. And for those of you who are still with me, you got it and the others did not. So thanks so much and see you next month.